And good afternoon. Welcome into Market Talk for this Thursday, March 3rd. Thank you so much for joining us, making us part of your day once again. I am your host, Jesse Allen, and thanks for joining us. Find us online, markettalkag.com is our home on the web, markettalkag.com. Facebook, Twitter, Instagram, all of our social media links are there. All of our streaming sources and much more. It's all online, markettalkag.com. Well, another wild day in this market trade today. That is for sure. Limit up in wheat, quart of beans, mostly higher, although beans did fade at the close. So we have plenty of storylines to talk about. No shortage of things to discuss with our good friend Mike Zuzolo, Global Commodity Analytics, joining us today. Mike, good afternoon, sir. It's been a few days since we've talked, and a lot has changed in these markets since the last time you and I talked. And it's just created a really volatile market environment right now, isn't it?
Yeah, and I think a couple things changed this week, especially Jesse, that ratcheted up that volatility you're talking about. I think the biggest thing that changed was the increase in violence and infrastructure damage that Russia has pursued, both in terms of hard infrastructure, and also in terms of civilian damage that they have gone ahead and pursued, much like they did back in 2008 with Chechnya. And I think this has really been the catalyst to waking the market up. And I'm trying to choose my words very, very carefully here because it's getting emotional at this point, seeing what's going on and watching this after 2 or 3 weeks. I think the biggest thing that the trade is realizing, along with the Western leaders that are trying to manage this situation, is that between Vladimir Putin talking about nuclear potential use of weapons and now what he has done, and especially the idea that he could use some type of lynchings or public hangings for Ukrainians that work against him and try and fight for their land. I think the trade realizes now in earnest that they are likely not to see the supplies of the Baltic come out, the infrastructure, whether it's the Mariupol port, whether it's the ships that are being blown up right now, whether it's breweries that are getting hit by missile attacks, or large oil storage facilities and tanks that we're all seeing on the TV. That the trade is now realizing that this supply issue is not going to improve unless peace breaks out pretty much right away. And I think that's the biggest negative factor looming over this market. If I ask myself every night now, what would be the biggest likely or the second biggest likely factor that would take this market down and create an environment where the funds who have clearly embraced the wheat market now, and that's something we've talked about for months, about the wheat being the leader and the funds needing to get underneath the wheat. They've done it now. Okay, so what is the most likely or second most likely factor to unwrap that? It would be peace breaking out in a real sense, relatively right away. So meaning before this weekend, or around this weekend. And I think the second thing would be that avian influenza. It's still out there. It's still spreading. Not much in commercial flocks, but it's now in Iowa. It's now in Michigan. It's now reportedly maybe in the Dakotas as well. So it's kind of encircling the Corn Belt. And so these are the two things that I always keep on the kind of side burner. But the center and the heart of this radar screen that I'm looking at right now is the idea that as the Paris wheat makes new all-time highs, it's really neat about today's trade. Look at what March soft red wheat did today. I didn't see the actual settlement, but it closed at 12.89. Guess what the price in the Paris wheat market was in an all-time high today? 12.89. We're running 1-to-1 with Paris wheat now directly because of Ukraine.
Well, and yeah, settled at 12.89. I mean, just huge volatility in those March front month contracts that are, in delivery, and you alluded to the Black Sea supplies and not getting those. And I would agree. I think the trade is realizing that we're not going to see those, and we're really seeing a lot of action around this, around the globe. A lot of global importers seeking replacements right now, and that seems like that's what's driving the wheat markets. And with the Russia Ukraine thing, we know that's a big market driver, but I know there's other things as well. We have to think about drought here in the Southern Plains with this hard red winter wheat crop. That's another big issue that Russia Ukraine is kind of just over, that's the big storyline, and the drought is starting to get a little overlooked, I think, Mike.
Yeah, I think it is. I mean, I think it's a timing issue. And I think, I sent you a picture earlier today, several of them. Yeah, here's the picture of right outside my office. This is the Atchison, Kansas, right on the Missouri-Kansas border of the Missouri River. And normally the pylons on this new bridge, this bridge is only about 5 years old. Normally the bridges and the pylons underneath the bridge would be covered, and at least there'd be no dirt at all, no sandbank or anything on either of these two pylons. And so on February 21st, I took this picture for clients. The first pylon closest to the eastern edge, the Missouri side of the river, was starting to show, but there was no sand or dirt at all between the purple arrow and the red arrow. Today, there is now a wide amount of sand, and you're well into almost a half of the river now not flowing at this point on the eastern edge or eastern side, Jesse. And this goes back to what you're just talking about and that drought monitor and that ag and drought chart that you just had flipped up here. We're looking at here, and it's really hard to imagine, but this is the winter wheat and drought in terms of agriculture production in the United States. You're looking at the top 8 states at 92% or higher drought. That ends up being about 65% of the winter wheat production totally. And so now you're sitting at a situation where those top 8 states have put all the winter wheat belt in about 73% of its area of the United States in drought. Last year at this time, it was 40% less. And this goes even deeper into what could happen in the corn and in the Western Corn Belt specifically. I just came back from a meeting in Grand Island, Nebraska last week and drove 2 different ways and just was amazed at how dry it was, even in irrigated country. And that was the talk at the meeting is how am I going to sell crops when I don't even know if they're going to come up? And that's what guys are talking about right now. And it makes sense because on the drought monitor map this week, even Iowa came in with a drought level of 98% from 92%, excuse me, on Iowa versus 52% a year ago. And this is just the outright drought monitor. And Nebraska now, in terms of a D1 to D4 drought, is at 98%. Almost 100% of that state of Nebraska has some significant drought level, and it's even a critical drought in some areas. And so that compares to 80% a year ago at this time. And the models don't look good. The models look very dry. And this is Hutchinson, Kansas for the 14-day weather outlook, both temperatures and precip. Temperatures above on the circle that I highlighted. Look at these lows. I mean, I've talked to clients from Western Kansas and Eastern Colorado, Southern Nebraska, and Wichita, Kansas, all the way down. They're breaking dormancy now. We hit 81 degrees yesterday, and we've been in the 70s all week this week here in Northeast Kansas. Those guys have been even warmer. So we're breaking dormancy, and yet we look at temperatures of potentially 18 degrees for lows on Tuesday, which is preceded by 25 degrees Monday morning and 29 degrees Wednesday, Thursday, and then back to 14 on Friday and Saturday of next week. I mean, that's enough to kill the crop if you have that many days in a row of below 26-degree temperatures. And that bottom circle shows Hutchinson's looking at less than 2/100ths of an inch of rain over the next 14 days. And yeah, these models can change, but it's getting too late. So this is where we're going to have to balance between what we talk about this week, Jesse, and what we talk about next week is how's the soft red wheat look in terms of Ukraine and the funds versus how does the hard red wheat look in terms of the drought and the freeze. And I think this spread trade is going to be historic next week if this all lines out that way.
Well, and on top of that as well, we talked about wheat being the leader. We've really pointed to this the last couple of months, Mike, when we've talked. And I know as well, how does that correlate over to corn? What is corn's role with Ukraine and everything going on and the drought issues and the dryness heading into spring planting and everything else under the corn market? I know we have this corn and soft red wheat monthly spread chart, and you mentioned the spreads a little bit. Talk about this chart just a little bit and maybe go a little more into what you're thinking we could see for the volatility here moving forward.
Yeah, what this chart says to me right now, Jesse, is that the wheat market and the corn market are essentially playing this trade more like 2008, where it's a wheat-led market. It's not like 2012, where the corn really was the one that got clipped and wheat kind of came away with that unscathed for the most part from getting hit too badly from that terrible drought. Now, that doesn't mean we can't flip to more of a 2012 scenario after we get planted. But for right now, we're trading a 2008 mindset. And if we are, and this is why I've always said the wheat to you, why I've always said the wheat's the leaders, because the amount of research I've done over the last 10 or 12 years, there's a real strong relationship between major lows in the wheat, especially soft red wheat, come about 30 to 45 days before major lows in the corn. And so therefore major highs are typically about a month apart between the wheat coming first and then the corn coming second. And I think we're setting up for kind of a similar scenario. So when producers, and this is what we're really talking about, is getting market intelligence out there to producers, whether they're ranchers needing to buy feed or corn and bean producers. When I talk to producers right now, my first line of hedging is still the soybeans. My last line of hedging is the corn. And a lot of the reason is because of this chart here, is that if we have a wheat price that's $4.50 premium to the corn, and it even stays, $2 or more premium for the next 3 to 6 months, we're going to knock wheat completely out of being a feed grain. And that's just going to create more demand for the corn on the feed side of the equation.
Great stuff, Mike. I want to talk this soybean complex a little bit. We kind of faded at the close on Thursday. Wondering what your thoughts are with that. Obviously, South American weather. We continue to watch that. More private estimates are coming in, lowering Brazil's soybean production. But I'm curious what you make of that late volatility on Thursday and that drop on the soybean market.
I think the two things. I think the trade is realizing the South American crops pretty much made with that latest rain that we got, and we had a decent rain last week, late in the week, and so we've been able to follow up a good rain with another good rain, and I think that really kind of taps the brakes on the weather bowl in South America, Jesse. So I don't think you're going to have a lot of new longs come into this market as a result of the South American weather from here on out. And therefore, the market's going to turn back its attention to the northern hemisphere, North American vegetable oil market. We noticed, and this is kind of a side note, we noticed that the crude oil market looked a little wobbly as the dollar ran up to its highest level since June of 2020 today. That created an environment where the bean oil spread got unwound on the long side against the bean meal. Long term, that's a healthy market where the meal leads. But for right now, the vegetable oils and the crude oil has been the thing that has led the soybeans up, other than South American weather. So you've got two major pillars or structures that has underpinned the soybean market that are a lot more shaky than they have been in the last 60 or 90 days. And I'll tell you the second thing I think really important that came out today was the weekly export sales. It's just not getting the job done as far as demand. So I think we're rationing demand in the beans. And Brazil came out with their February export numbers. They came in with, looks like 6.27 million tons of soybeans exported in February. That is almost triple what they did in February 2021. So put all this stuff together, and where I'm at right now, Jesse, I'm exactly where I was back on February 3rd of a month ago, wanting to hedge up to 100% new crop soybeans. And the only thing that stopped me, and I only did about 10% over the course of the last 30 days, has been this Ukraine-Russia conflict and allowing this market to run with the crude oil. But I really am sincerely wanting to get 100% hedged again before the acreage intentions report at the end of the month, because beans have run the longest, and these factors that we're talking about are not really underneath us now to drive this market sharply higher. And I think this goes back to the soybeans. Lead month soybeans were able to get up to 1965 last month. We haven't been able to take that price out yet. And in fact, as we closed off today, you rightfully point out the pullback. We're only about 20 cents off our close from last month in new crop soybeans. So we really aren't putting much premium in the beans as this wheat and now the corn start to drive the bus. And this makes sense because the trade's been buying beans, selling feed grains. Now they're going to do the opposite with the conditions we have right now.
In your travels here the last week or so, where you talk to farmers, do you think that these volatile prices and some of these big moves higher, do you think it's going to shape the acreage battle here in the next few weeks? Do you think there's going to be some late switches for guys that are going to be planting something else versus what they intended here a month ago? What are you hearing on that front, Mike?
Yeah, great question. Eastern Corn Belt, yes, most definitely. We're pulling some bean acres into the fray now, away from corn, especially with the recent move up in the soybeans, and also the trade understands that, and the farmers understand that we're not going to probably get the nutrients we need in the first half of the calendar year of 2022. So it really makes you wonder, what is my yield going to be? And I had a conversation with the cash only client this week, and we were talking about his yields, and he had record yields in north central Indiana last year. And he's looking for a 220, 225 average based upon much better than that last year. Well, he's going to probably get that because of the fact that he has a lot of his inputs already booked. and he got it done last fall, and so he's pretty secure on his supplies. But there's a lot out there, probably a third, I would guess, of producers that are still kind of hung out there, especially for locking in their fertilizer needs if they run a 28 or something that's post-emergence that they haven't locked in yet. So I think that's really going through their heads right now. The thing I'm picking up most sincerely, though, is down in Oklahoma, now in Kansas and southern Nebraska, and these maybe what you would consider fray Western Corn Belt, but still part of the acreage mix, especially given the last 5 years. They are definitely losing their wheat crop at this point, and they're going to oil seeds, and they're not going to feed. They're not going to forage, I should say, with their cattle. They're letting their cattle go to the lots, and they're going after an oil seed or a milo, something that you can't forage off of. And I think that's where the real acreage switch is going to come from, between more hard red wheat acres and more corn acres go to soybeans. And that's where I actually think that the agricultural outlook numbers that the baseline projections USDA did last week are pretty dated at this point, both in terms of showing bigger demand for corn, beans, and wheat. I don't think that's in the books anymore at these prices. And I don't think you've got the acreage base in the wheat and the corn that they suggest you do right now.
Want to give us time to touch on livestock. Fairly decent export sales today for both beef and pork, but cattle market just under a lot of pressure again today with the higher grain prices, I would assume, mostly. And then, hogs did their best to be mixed, at least on the day, but really just a tough day throughout all of livestock. What are your thoughts there, Mike?
Yeah, this has been a week where the fat cattle have been pinned up against a much sharper, lower feeder cattle market because, as you say, the grain rally, and yet it's been underpinned by the sharp rally at times by the hogs, and the strength in the hogs thanks to the soybean trade. That pork and bean trade we talk about, Jesse, that's still running. That relationship between lead month soybeans and lead month hogs is still running over 90% positive right now on a 16-week basis. And so funds are still coming in, buying both beans and buying hogs. And that's where the hog weakness is usually bought, because of the bean strength. So tomorrow, I think, is going to be a real critical day. And as we finish out the week, it's going to be a real critical day, because if beans go negative, do we then have a scenario where fat cattle have to deal with both weaker hog prices and weaker feeder prices? And with the cash market really disappointing me this week, and actually losing $1 to $2 in Nebraska and Kansas, and going back to that 140 kind of pukey level for producers and ranchers, I'm really disappointed with the cash market. So if that cash market doesn't develop nicely by Friday, I think the fat cattle could go in there along with the feeders and test some of these recent lows, like the Monday lows, especially in the March feeders. So I think we're playing defensive in the cattle market until that cash turns around. We obviously have a weak seasonal now with the Easter time period, but I'm really still thinking, because of the high feed prices and what's going on with the drought we've been talking about, that packers should, in terms of what they should be paying, should be up in the mid 140s right now. So I'm telling producers to try and maybe build some of their weights out here and delay their marketings if they can get away with it, and not spend too much on the feed, waiting for mid 140s before we market.
Well, Mike, before we run out of time, floor is yours. Anything else you want to mention here on this Thursday?
I would say get a hold of me if you really don't understand these markets. I was surprised in Grand Island. I spoke to over 200 people in Grand Island last week, and many came up to me and said, I've never heard any presentation like this before, and I really don't understand it that well. That's common, because this is all pretty new stuff in the last 5-6 years. So please get a hold of me. I'd be happy to talk to you some afternoon or some evening. Just let me know on the website, globalcomresearch.com. Sign up for a free trial, and in the comments where we ask you to tell us about yourself, just tell us about what you need from us, and we'll get a hold of you.
Globalcomresearch.com is a website to get a hold of Mike, and you can do that very easily there. Globalcomresearch.com. Mike, appreciate the time. Thanks for joining us this week. We'll talk to you next week, sir.
Thanks for having me, Jesse, as always.
Mike Zuzolo with Global Commodity Analytics, our guest today on Market Talk. That's going to do it for this Thursday, March 3rd edition of the show. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.